If current projections remain unchanged, Social Security reserves could face significant pressure within the next several years. And that is why many retirees are asking a serious question right now. If lawmakers continue delaying action, how long can full monthly benefits continue without changes to the system? The most important point to understand first is that Social Security is still paying full benefits today. Retirement checks, survivor payments, disability benefits, and spousal benefits continue on their regular schedule under current law, and there has been no official announcement of any immediate reduction for people receiving payments in 2026. Right now, payroll taxes paid by workers and employers still provide the largest share of Social Security funding. Every paycheck across the country continues feeding into the system through payroll deductions, and that money supports current beneficiaries every month. But in recent years, total benefit obligations have grown larger than total yearly revenue, which means reserve funds are helping fill that difference. That reserve support has become increasingly important. Official financial reports show that annual Social Security revenue remains very large, but benefit payments now exceed incoming revenue each year. When that happens, the system uses part of its reserve funds to keep all scheduled payments going without interruption. Those reserves were built over many decades precisely for periods like this. They were designed to help absorb pressure when demographic changes create larger benefit demands. Today, with millions of baby boomers already retired and more Americans reaching retirement age each year, that pressure has become much more visible. According to the latest trustees' projections, if no legislation is passed, reserve balances could become much smaller in the early 2030s. Even then, Social Security would not disappear. Payroll taxes would still continue coming in every month. But incoming revenue alone may not fully cover every scheduled benefit at today's level unless Congress adopts a long-term solution. That means the issue is not whether Social Security ends. The issue is whether lawmakers act early enough to protect full scheduled payments before reserve funding becomes more limited. For current retirees, this matters because any delay affects more than future generations. If no funding adjustment is approved in time, current beneficiaries could also feel the impact because the system pays according to available funding under federal law. That is why this discussion remains so important in Washington. Lawmakers understand that millions of older Americans depend heavily on Social Security as their main source of monthly income. For many households, Social Security is not just supplemental support. It covers rent, mortgage payments, groceries, electricity, medicine, transportation, insurance, and basic household costs. Even a modest reduction would be felt immediately by many families. The encouraging part is that several possible solutions have already been discussed for years, and experts agree that multiple policy paths remain available. One proposal often discussed is adjusting the taxable earnings cap. Currently, workers pay Social Security tax only up to a yearly income limit. Earnings above that level are not taxed for Social Security purposes. Some lawmakers argue that raising that cap would allow more revenue to flow into the program, especially from higher earners. Supporters of that idea say it would strengthen long-term funding while leaving the core benefit structure intact for retirees. Another proposal often mentioned is gradually adjusting retirement formulas for younger generations over time rather than making sudden changes for current retirees. Because retirement planning often takes decades, lawmakers generally approach that option carefully. Some policy experts also suggest combining several smaller changes instead of one major reform. That could include moderate tax adjustments, phased benefit formula updates, or gradual changes spread over many years so households can prepare. One common misunderstanding is the belief that fraud alone could solve the long-term funding challenge. Fraud prevention remains important, and Social Security employees regularly review suspicious claims, payment errors, and improper records. But experts consistently explain that even aggressive fraud reduction would not fully close the projected long-term funding gap. In other words, stronger oversight helps, but larger financial decisions are still required. Another misunderstanding is the belief that reserve funds have somehow disappeared already. According to official reports, reserve funds still exist and continue helping support full payments right now. That means current benefits are still backed by both payroll tax revenue and reserve support under current law. Another concern many viewers ask about is whether current checks are in immediate danger. As of now, the answer remains no. Social Security continues paying benefits on schedule, and no official reduction has been approved for 2026. That includes retirement payments, disability benefits, survivor support, and supplemental security income for eligible recipients. For seniors already budgeting carefully each month, that stability remains very important. Payment calendars continue normally, and official federal agencies have not announced any immediate disruption. Another important issue many retirees ask about involves working after claiming benefits. In some cases, continuing to work can increase future monthly payments. Social Security reviews yearly earnings and compares them with a person's highest 35 earning years used in the original benefit calculation. If a recent year replaces a lower earning year from earlier in life, the monthly benefit may increase after recalculation. That review process can take time. Earnings records are processed after tax reporting is completed, so adjustments often appear months later rather than immediately. When that recalculation is finished, Social Security can also issue back pay covering earlier months if a higher payment should have started sooner. That is why some retirees suddenly notice an unexpected deposit later in the year. In many cases, that reflects a delayed earnings adjustment rather than a policy change. Another reminder worth understanding is how Social Security was originally designed. It has always functioned as a shared national insurance system rather than an individual savings account. That means today's workers support current retirees, survivors, and disabled beneficiaries, just as previous generations supported those before them. This structure is especially important for survivor benefits. Families can continue receiving support when a working spouse or parent dies, even if retirement age was never reached. That shared protection remains one of the strongest features of the system, and one reason Social Security continues to hold broad public support. For now, the practical message is steady. Current benefits continue normally. No immediate reduction has been approved, but long-term funding decisions are becoming more urgent as updated federal projections approach. New financial reports are expected again this year, and those updated figures may shift depending on inflation, employment levels, wage growth, and payroll tax revenue. Until official legislation is introduced, retirees should focus on trusted government notices, annual Social Security statements, and confirmed federal updates rather than dramatic headlines. At this moment, your monthly payment remains active, your benefits remain protected under current law, and the larger funding discussion remains under review in Washington. Sara will continue following every confirmed development carefully, and when official changes are announced, you will have a calm and clear explanation of what is confirmed, who may be affected, and what steps deserve attention first.